Hello folks, I'm Adam Livingston and today I'm going to be performing a sacred rite. We're not here for a market update today, we're here for a funeral. Specifically, the funeral of the global bond market, a $140 trillion hospice patient that's been on life support since Alan Greenspan was still lucid. It's time we pull the plug, say a few words, and let the debt die with dignity. Now, before we begin, if you are holding long-duration treasuries in your IRA because some Merrill Lynch advisor named Rick told you they were safe, this might be uncomfortable. You may even be tempted to whisper, but bonds always bounce back. They don't. They're not Tesla, they're not Bitcoin, they're financial asbestos wrapped in a coupon. And to the boomers in the back, respectfully, get out of bonds. You've been living in a time when duration was your friend and inflation was a myth. That era is over. You cannot golf your way out of this one. Bonds won't protect you from what's coming. They're not your parachute, they're your weighted vest. This presentation today is a post-mortem and a reckoning. It is also a love letter to the only asset left on earth that isn't lying to you every 30 days with a coupon and a prayer. So light a candle, put your hand on your Bloomberg terminal, and let's begin. Let's begin with the headline, $147 trillion. That's the current size of the global fixed income market. A number so large it only exists because no one ever expects to be repaid. In 2023, it did grow by 5.9%, not because the world got richer though, but because governments couldn't stop borrowing to keep the Ponzi alive. Now zoom into 2025, the OECD projects $17 trillion in new sovereign issuance. That's desperation. It's a supply gut masquerading as fiscal policy. Every new bond issued digs the yield curve deeper into unrecoverable convexity. Yields are screaming the truth. The 10-year is pressing 4.6%, and the 30-year just pierced 5. Levels we haven't seen since 2007, right before the last credit heart attack. This isn't cyclical, it's structural demand fatigue. Here's the thesis. Debt instruments have transitioned. They're no longer risk-free collateral. They are slow-motion default contracts, time bombs priced by denial. Meanwhile, Bitcoin rises, not as a speculative trade, but as a zero-liability, 24/7 global settlement asset. Scarce by code, untouchable by central banks. The exit. The patient is dead, now let's cut it open. First, real returns are negative. The U.S. aggregate bond index posted a meager 1.25% in 2024. CPI is running north of 3%. That's guaranteed capital erosion dressed up as income. Now let's look at the blood loss, foreign bid evaporation. The most recent 30-year treasury auction had a 58.9% foreign takedown, the lowest since 2019. That's a global vote of no confidence. The hemorrhage continues, $881 billion per year in U.S. net interest outlay. Interest expense is now the third largest line item in the federal budget, crowding out everything from defense to discretionary infrastructure. The empire isn't expanding, it's servicing coupons. But here's the kill shot duration risk. With an average duration of 7 years, even a 1% upward shock in yields vaporizes $9.8 trillion in capital value across the bond complex. What we're witnessing is a death spiral. The bond market isn't functioning as a store of value or a capital allocator. It's a highly levered Mark II model hallucination, and the dream is ending. We are now standing at the edge of the refinancing abyss. 40% of OECD debt matures within the next 36 months. That's not just a wall of maturity, it's a debt demolition derby. Every bond that rolls over needs to be reissued, but now at the highest coupon rates since the global financial crisis. In the United States, this means the debt to GDP ratio is set to exceed 6%, and it's accelerating. Not because of new spending, but because of old promises coming due in a structurally higher rate environment. It's the fiscal version of being forced to refinance and subprime mortgage at twice the rate with the gun to your head and the lender laughing. And it's worse for the emerging markets. Over 50% of EMDE sovereign bonds mature before 2027. That's more than half the debt in economies already strained by inflation, currency volatility, and weak external demand. The OECD has formally flagged this as a systemic refinancing risk, but markets are still pretending it's business as usual. Here's the punchline. Bond math no longer self-funds. In the past, interest payments were recycled via reinvestment. Now, that cash flow flies out the door, and what returns is convexity metastasis, a cancer of negative duration dynamics. Every auction feeds the tumor. Every rollover deepens the fragility. We are not refinancing a system anymore, we're embalming it. Let's look at what happens when the plumbing breaks. The repo market, the heart of the dollar liquidity system, is choking on fail to delivers. Why? Because when volatility surges, value at risk models force dealers to mark down inventory and widen haircuts. That means fewer bonds qualify collateral just as liquidity is most needed. Meanwhile, cross-currency basis spreads are blowing out. The JPY USD cross basis recently hit minus 54 basis points, forcing Japanese institutions who are already yield starved to dump treasuries en masse just to avoid bleeding out on swaps. This is the financial equivalent of selling your kidneys to pay rent. Fallback collateral is vanishing, bills are scarce, dealers are hoarding, and as a result, term premia are migrating to the long end, distorting duration pricing and flattening risk asset multiples. It's a seizure in the global collateral engine. When trusted sovereign bonds become unstable, every derivative, every margin requirement, every overnight funding assumption has to be repriced. Every time Jay Powell has a mood swing. That asset's name starts with a B. Now let's talk about the solution, not a hedge fund darling, a new base layer for civilization itself. Bitcoin is no longer just a monetary asset. It is a global resettlement engine operating with surgical precision while the fiat system hemorrhages trust. On-chain throughput now exceeds $12.9 billion per day, or $4.7 trillion annualized. That's real capital moving peer-to-peer trustlessly without a single bond trader touching a Bloomberg terminal. Meanwhile, stablecoin rails, many of them clearing via Bitcoin level 2s or Bitcoin-backed infrastructure, eclipsed 10 trillion in annual volume in 2023. That's 2.5x the volume of Visa. And Visa isn't being used to settle corporate treasuries or cross-border bond outflows. Finality, 10 minutes. Credit risk, 0. Uptime, 99.99%. Compare that to the US Treasury, which halts every time a regional bank sneezes. Here's the deeper moat, folks. Bitcoin's security budget scales with price. The more valuable the network, the more energy is deployed to defend it. The legacy system dilutes under stress. Bitcoin fortifies. It's not just anti-fragile, it's reflexively sovereign. The best part, it settles trillions of dollars, and it doesn't even have a CEO. Let's run the numbers, because belief without basis is religion, and we're here for monetary physics. Over the last 5 years, global bonds have returned a 0.9% compound annual growth rate. Bitcoin, 1,100 compound annual growth rate. That's not a typo. That's a 1,099% differential. And no, it's not luck. It's a convexity built on digital scarcity versus a dying structure of debt-based time decay. The Sharpe ratio, bonds 0.1, aka take risk, get nothing. Bitcoin 1.7, a full 1.6 spread in risk-adjusted return, despite higher volatility. Now, yes, Bitcoin is volatile. Its worst 12-month return post-2020 was around negative 45%. But here's the uncomfortable truth for fixed income managers. US bonds lost 17% in a single year. That's your supposed rock asset breaking like wet drywall in a hurricane. And unlike Bitcoin, bonds don't bounce back with halvings and reflexive demand. They just sit there and bleed coupon by coupon. Liquidity risk is real in Bitcoin, but it's transient. Meanwhile, duration and inflation risk in bonds is structural. Bitcoin's time-weighted alpha isn't just greater, it's exponentially greater. This isn't about replacing bonds with risk, it's about replacing decay with a growth engine that doesn't ask for permission or bailouts. The traditional 60-40 portfolio is now a museum exhibit. In theory, bonds provided negative correlation and income. In practice, they now provide simultaneous drawdowns and budgetary ulcers. Let's optimize. Monte Carlo simulations, 10,000 runs, using a BTC volatility of 70% and a cross-asset correlation of 0.25 with the S&P 500 show something staggering. Replacing just 10% of bonds with Bitcoin boosts the 5-year risk-adjusted return by 2.3x at the same volatility level. Let me say that again. Same risk, more than double the reward. But what about downside risk? Bitcoin at less than 15% keeps your 1-year value at risk on par with a 40% bond sleeve. Because bond convexity collapses are now fatter tailed than Bitcoin drawdowns. Bonds are the new crypto, except with no upside, no community, and no memes. This isn't a theoretical backtest, it's a probabilistic indictment of legacy diversification models. Modern portfolio theory didn't account for monetary debasement, negative real yields, or digitally native collateral. The frontier didn't just shift, it's been obliterated. Now let's zoom out and look at what happens if the capital starts to flow. With a modest 5% rotation out of global bonds into Bitcoin, that's a $7 trillion bid. With 19.7 million BTC in circulation, that implies an incremental price lift of 355,000 per BTC. Add that to a 112K base case, and you're now staring down a target north of 450K per coin. Without any change to supply, no marketing, no yield curve, just math. And then here comes the reflexivity loop. As price rises, the marginal cost of capital for BTC treasury corporates drops. More firms issue debt, convert it to Bitcoin, and lock it in asymmetric upside. The higher BTC goes, the cheaper it gets to buy more. It's monetary perpetual motion built on thermodynamically sound collateral. Meanwhile, sovereign debt spirals into negative convexity, liquidity gaps, and political paralysis. Bitcoin becomes the global liquidity sink, the final asset that doesn't default, dilute, or freeze during macro stress. This is monetary gravity reasserting itself. It's not enough to understand the theory. You need a playbook. This is where Bitcoin leaves gold in the dust and bonds in the grave. You got to replace duration, sell your 10 to 30 year sovereign exposure, rotate into Bitcoin and T-bill ladders. You preserve liquidity with bills and harvest convexity with Bitcoin. Duration is no longer an asset. It's a liability priced in denial. There's also a volatility overlay. Bitcoin has fat IV premiums. You can sell short-dated covered calls and you synthetically recreate bond-like carry, except your principal isn't eroding in real terms. You're harvesting vol, not praying for Powell to pause. A real 80 to 20 BTC T-bill ratio, rebalanced quarterly with delta hedging, outperforms TIPs on real rate parity. This structure provides convex upside, deflation resilience, and inflation immunity. In other words, triple redundancy. Traditional bonds can't offer that. At best, they can give you the illusion of safety and a tax bill. And lastly, regulatory arbitrage. Deploy spot-settled BTC ETFs under a 1940 Act wrapper. This captures institutional mandates before 2026 pension rule revisions. It's the front run of the century. Because once retirement funds are allowed to go overweight Bitcoin, the trade is already over. Bitcoin isn't just an asset class, it's a toolkit. Use it like one. Let's summarize what we just buried and what we've just unearthed. Bonds are no longer risk-free return, they are return-free risk. You lend to insolvent governments for 30 years and pray they don't default in slow motion. That's monetized Stockholm Syndrome. Bitcoin, by contrast, converts terminal debt instruments into digitally pristine collateral. It doesn't decay. It compounds. It doesn't ask for bailouts. It removes your need to ask anyone for anything. The macro catalyst stack is locked in. Monetary debasement? Check. Fiscal insolvency? Check. Institutional settlements migration? Already underway. This is a unidirectional capital flow from fiat debt to digital equity. From a world where capital bleeds out in basis points to one where it grows at block speed. The optimal strategy is now simple. Don't treat Bitcoin as a speculative allocation. Treat it as the core reserve asset of a post-sovereign bond world. Because when the system burns down, the only collateral that settles is the one that can't default. My name is Adam Livingston, and this is not financial advice. This is financial entertainment.